Good day, ladies and gentlemen, and welcome to the TCS Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kedar Shirali. Thank you, and over to you, sir.
Thank you, Margaret. Good evening and welcome, everyone. Thank you for joining us today to discuss TCS's financial results for the fourth quarter and full year of fiscal year 2019, ending March 31st, 2019. This call is being webcast through our website, and an archive including the transcript will be available on the site for the duration of this quarter. The financial statements, quarterly fact sheet, and press releases are also available on our website. Our leadership team is present on this call to discuss our results. We have with us today Mr. Rajesh Gopinathan, Chief Executive Officer and Managing Director.
Good evening, everyone.
Mr. N.G. Subramaniam, Chief Operating Officer.
Good evening, all.
Mr. V. Ramakrishnan, Chief Financial Officer.
Hello, everyone.
And Mr. Ajoy Mukherjee, EVP and Head of Global Human Resources.
Hi, everyone.
Rajesh and Ramki will give a brief overview of the company's performance, followed by the Q&A session. As you are aware, we don't provide specific revenue or earnings guidance, and anything said on this call which reflects our outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. We have outlined these risks in the second slide of the quarterly fact sheet available on our website and emailed out to those who have subscribed to our mailing list. With that, I'd like to turn the call over to Rajesh.
Thank you, Kedar, and once again, welcome everyone. It gives me immense pleasure to share with you that we are wrapping up FY19 with the strongest revenue growth in many quarters and double-digit growth for the full year. Our Q4 revenues grew 12.7% year-on-year on a constant currency basis and 8.5% in dollar terms and 18.5% in rupee terms. Full year revenues crossed the 20 billion mark, growing 11.4% in constant currency and 9.6% in dollar terms and 19% in rupee terms. Our operating margin for the year is 25.6 compared to 24.8% in the prior year, expansion of 79 basis points. Our net margin for the year was 21.5% compared to 21% for the prior year. I'll now ask Ramki to go over all the headline numbers, financials, and segmental performance, and I'll step in again later to talk about some of the demand trends that we are seeing. Over to you, Ramki.
Yeah, thank you, Rajesh. Let me go over the headline numbers. In the fourth quarter of FY 2019, our revenues grew 2.4% Q-on-Q and 12.7% Y-on-Y on a constant currency basis. Reported revenue in INR was rupees 380.1 billion, which is a year-on-year growth of 18.5%. In USD terms, revenue was $5.39 billion, which is a Y-on-Y growth of 8.5%. For the full year, our US dollar revenue was $20.91 billion, a Y-on-Y growth of 9.6%. The revenue growth is 11.4% in constant currency and 19% in rupee terms. Let me now go over how the different segments performed during the quarter. As a reminder, all the growth numbers are year-on-year and in constant currency terms. Growth was broad-based during the quarter, with most verticals and geographies growing in double digits or thereabouts. We saw continued acceleration in our banking, financial services, and insurance vertical, with growth finally crossing over into double-digit territory in Q4 after 9 quarters, growing 11.6%. Life sciences and healthcare grew 18.2%, energy and utilities grew 11.3%, communications and media grew 10%, retail and CPG grew 9.9%, and manufacturing grew 9.2%. Revenue from digital engagements made up 31% of our revenues in Q4, a growth of 46.4% year-on-year. For the full year, 28.6% of our revenues were from digital engagements, a growth of 50.6%. Geography-wise, all our major markets grew in double digits or thereabouts in Q4. Growth was led by UK, which grew 21.3%, and Europe, which grew 17.5%. North America grew 9.9%. Other markets also continued to grow well. Asia Pacific grew 11.5%, India grew 11.3%, and Latin America grew at 16.2%. Our expanding suite of products and platforms are doing very well in the marketplace. Ignio, our cognitive automation software, is doing exceedingly well and steadily expanding beyond IT operations into business operations. It currently manages over 1.5 million technology resources autonomously for over 90 clients across the world. Our assessment platform, ION, continues to expand its reach both in terms of having a physical presence in every state and union territory in India and in terms of the number of candidates who have been assessed on this platform. In FY19, ION conducted 750 plus exams, added 300 plus learning products, and also delivered world's largest digital assessment of 23.7 million candidates. Mastercraft, our digital platform to automate and manage IT processes, has become all the more relevant as Agile and DevOps adoption accelerate. We had 22 new wins in FY19. In terms of automating application analysis and code generation, it analyzed 100 million lines of code in FY19 and generated 25 million lines of code. We launched Agile, our SaaS-based scalable Agile DevOps platform in FY19, and it has had 11 wins during the year. Our industry-focused products and platforms continue to grow well and gain share. TCS BaNCS, our flagship product suite in the financial services domain, had a very good year with 18 new wins and 29 go-lives in FY19. Optumera, our AI-powered merchandise optimization platform that enables retailers to unlock exponential value by optimizing their space, mix, and price in an integrated manner, had 5 new wins this year and 4 go-lives. 2 allied platforms, OmniStore and AI, each had 2 wins in FY19. In life sciences, TCS's Advanced Drug Development Platform, ADD, which is a comprehensive suite for digital transformation of drug development, at 7 new wins and 2 go-lives in FY19. Hobbs, our plug-and-play SaaS-based business platform to digitally transform business, network and revenue management in telecom, has now expanded into new subscription-based businesses such as prepaid DTH, aircraft engines, retail, and airlines. Hobbs had 6 wins and 8 go-lives in FY19. The transformational work we are doing for customers is expanding our share of wallet and resulting in broader and deeper engagements. This is reflected in the client metrics, which continue to show strong movement of customers up the revenue brackets. In FY19, we had 44 clients in the $100 million plus revenue band, 6 more than in the prior year. Other buckets had strong additions as well. We added 2 more clients in the $50 million band, bringing the total to 99, 8 clients in the $20 million band, bringing the total to 215, 21 clients in the $10 million band, bringing the total to 371, 37 clients in the $5 million plus band, bringing the total to 532, and 45 clients in the $1 million band, taking the total into 4 digits for the first time to 1008. Let me now go over some of the financials. Our operating margin for this quarter was 25.1%. For the full year, our operating margin was 25.6% and 0.8% expansion over the prior year. Our net income margin was 21.4% during the quarter. For the full year, it was 21.5%, which is a 0.5% expansion over the prior year. Effective tax rate for the year was 24.1%. Our accounts receivable was at 69 days DSO in dollar terms, the lowest ever. Net cash flow from operations was rupees 316.7 billion, which is 21.6% of revenue and 100.6% of net income. Free cash flow in FY19 was rupees 295.4 billion. Invested funds as at March 31st stood at rupees 496.5 billion. The board has recommended a final dividend of rupees 80 per share, bringing the total for the year to rupees 30, which is a payout ratio of 42%. Including all the dividends paid out in FY19 and the rupees 16,000 crore share buyback we had in September, the total cash return to shareholders was rupees 27,472 crores, which is 93% of our FY19 free cash flow. Moving on to the people front, our investments in organic talent development are delivering phenomenal learning outcomes. TCSers collectively logged in 52 million learning hours in FY19. As of March 31st, we have trained over 311,000 employees on digital technology and over 348,000 employees on agile methods. To support our growth, we continue to tap into talent pools across the world and add to our ranks. During this quarter, we added 6,356 employees on a net basis, bringing the total net addition for the year to 29,287. Our focus on diversity and inclusiveness continues to yield results. The proportion of women in the workforce rose further to 35.9%. The number of nationalities represented in our workforce stood at 147. All of this is resulting in a very vibrant and engaging workplace that attracts and retains talent. We continue to enjoy the lowest attrition in the sector globally. LTM attrition in IT services in Q4 was 11.3%. I turn it over to Rajesh now for the demand drivers and other trends.
Thank you, Ramki. When we look back at the last fiscal year, there are 4 clear trends in customer spending which has been driving our strong growth and differentiated positioning in this market. I'll go through each of them, and starting with Business 4.0. About 18 months back, we unveiled our Business 4.0 framework, identifying 4 key behaviors of successful organizations in the digital era, namely mass personalization, leveraging ecosystems, embracing risk, and creating exponential value. We saw this resonate very strongly with our customers, particularly in industries which were getting disrupted by technology-based players. I'm very happy to note that our Business 4.0 framework is now becoming the de facto model that enterprises across the world are adopting to guide their growth and transformation initiatives. In a survey we commissioned in December, we found that over 90% of 1,200 enterprises polled had adopted at least one of the 4 Business 4.0 behaviors that we had called out. Interestingly, nearly a tenth of the enterprises had adopted all 4 behaviors, and these were the companies that were also at the forefront of adopting cutting-edge digital technologies like AI and blockchain. Understandably, these leaders are also seeing superior business outcomes from these initiatives, with 6 out of 10 such organizations expecting double-digit growth over the next 3 years. We strongly believe that enterprises will rely more and more on technology to drive their competitive differentiation and to power their growth and transformation agendas. And this will be a long-term growth driver that we will be participating in. So Business 4.0 has truly acted as a phenomenal bedrock on which we have been building our go-to-market strategy and our participation and the growth that we're seeing out of it. The second big area has been innovation. It's in many ways related to the first one. Enterprises are investing heavily in innovation, looking to harness the combinatorial power of IoT, analytics, and machine learning to enhance the customer experiences, to enhance productivity and profitability, and establish competitive differentiation. Many of our customers, like Total and Newcrest, are partnering us to set up dedicated innovation centers focused on leveraging digital technologies to reimagine core parts of their business. Our investments for the last many years in research and innovation, leveraging our deep domain expertise, have resulted in innovation solutions in every industry vertical and intellectual property like accelerators, frameworks, products, and platforms. For example, the TCS algorithm in the algorithmic retail, which is now powering dynamic pricing and other core retail operations for some of the world's biggest retailers, is an outcome of our research and innovation efforts in this vertical. We have set up innovation centers across the world to serve as innovation showcases, which will help us initiate conversations with customers and better externalize these capabilities and collaborate effectively with customers and get them thinking about how to apply these ideas to their specific context. The third big dimension of our strategy, which has been powering this differentiated growth, is our focus on Agile and MFDM. It is impossible to talk about innovation without also talking about Agile methodologies. Speed to market is critical to many of these growth and transformation initiatives, and our ability to deliver that speed to market with our reimagined Agile model has been instrumental in winning many large transformation deals. Our big innovation has been to break out of the constraints of co-location that have limited the use of Agile to small localized projects until now. Our unique, differentiated, location-independent Agile model is tailor-made to suit the requirements of large organizations whose business users are distributed across the world, making co-location quite impractical. This enables adoption of Agile scale and helping us win large transformation engagement. Today, we have an Agile footprint with over 500 of our customers and have executed over 6,000 agile engagements. Increasingly, we are talking to customers about enterprise agile method, taking agile beyond just IT projects and using agile concepts to transform all aspects of their business. The other dimension of our strategy is what we call the machine first delivery model, or MFDM. This is basically a way of integrating technology deep within the enterprise to redefine how humans and machines work together and to more effectively deliver superior outcomes by offering technology the first right of refusal for all work. These two dimensions go hand in hand. Human ingenuity, creativity, and empathy are as important as machine-driven speed and scale in meeting the objectives of today's digital transformation programs. The final element of TCS strategy has been what we call core transformation. When customers launch their innovation and transformation initiatives, the biggest barrier to success is often the legacy operating stack consisting of either process delivery or underlying systems and the infrastructure around which. To help them get the digital outcomes they need, we are partnering customers in holistically reimagining their operations by applying our machine-first approach across their entire stack and automating business processes and IT operations and simplifying the legacy application stacks, eliminating redundancies and re-architecting with modern cloud-native structures. These are very large multi-year transformation engagements, large in scale and scope, and we are winning such deals by leveraging our contextual knowledge and our ability to stitch together different capabilities from across TCS. The outcome for the customer is a new digital core, which is much lighter, smarter, and nimbler organization and places the organization better and positions the organization better to win in a business 4.0 world. So these four trends have been driving up demand for our services and helping us participate aggressively in the opportunities we see out there. This quarter, we have had very strong deal closures, bigger than our previous 3 quarters this fiscal. The total TCV of contracts signed in Q4 was $6.2 billion. As we look ahead, despite the macro uncertainties in major markets and pockets of volatility in BFSI, automotive, technology, etc., we see 3 areas. Our accelerating trajectory through this year gives us a strong exit, locking in 3.6 CC growth for FY20 versus a 2.8 tailwind that we had entering FY19. This, along with the solid order book and a very robust deal pipeline, gives us confidence as we enter the new fiscal year. Before we open this line for questions, I have one more happy news to share with you. We are going to celebrate Ajay's 39 years with TCS, and this has been a long journey, and in many ways Ajay epitomizes everything that TCS stands for. Over this period, he has seen everything practically and played every role possible. Unfortunately, this is going to be his last earnings call, and we wish him luck, and this is your last chance to ask him whatever you want to ask. So please go ahead and make use of the opportunity. With that, we open the line for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Hi, thanks for taking my question. Rajesh, very good execution and very good quarter. Just couple of questions. Already you mentioned, you don't have much clarity on what will happen on the macro, so you don't have anything to share right now. But I would like to understand that given the uncertainty or early signs of some worries which are coming in, are you seeing any lead indicator which is suggesting that in some of our BFS clients there could be some stress? And are you also getting a confidence based on our strong TCV in the quarter that that stress could kind be offset by the new contracts we have signed? And second, on the digital again, what is exactly driving such a strong growth there? We understand the whole ecosystem of IoT and digitization is driving that. But can you just highlight which particular industries are doing extremely well on that, and how do you see it going forward? And secondly, on margins, if some light could be thrown on the range of margin guidance, which aspirational guidance or whatever you call it, which you have highlighted earlier, do you maintain that, or is there any change in stance on that?
Okay. Sandeep, on macro, our discipline and our guidance to all our field is that we should not talk ourselves into a problem, and we should stay focused on the opportunity. Again, as I said in the press conference, our experience in UK over the last year is a great example of this. In a market that is a poster child of macro volatility and all kinds of problems that you could possibly think about, we have delivered 22% growth. And the key element is that it is not the macro that buys from us, it is customers who buy. And as long as our field teams stay focused on that and focused on the opportunities that are out there, our participation will continue to be strong. So there is, on macro, you guys understand it a lot more than we do. We don't have anything incremental to share with you. We can only talk about the opportunities that we see and the deals that we have. Beyond that, we have a strong team, and we are out there in the field to play, and we'll do our best. On digital, this is becoming practically a default across multiple industries. Different industries are at different points on this journey. You have industries like media, which have been totally transformed. There, the entire product, from its development to its distribution to its consumption, entirely has gone digital. You see it happening in retail, where the buying behavior has substantially moved first away from the store to the web, and now from away from the web to the social media. And it is getting more and more away from the retailer, and they need to participate where the customer is. You see this in banking, and you see this across in automotive, where Case is reimagining it. You see it in utilities. So it is no longer an industry-specific phenomena. It is widespread, and that is where the growth is coming from, because it is so secular. The participation is also very wide, and it has a lot of wings. The last question that you had was on margin. Given the opportunities that we see, and given the structural significance, and in fact the increasing structural significance of technology in the value chain of multiple industries, we believe that this is a perennial demand. The specifics of it will keep on changing, but this is a very core element. And given the rate of change of technology, which will only keep on accelerating, our relevance to our customers will also continue on a very, very deep basis. In fact, it will keep on increasing as long as we are disciplined to stay invested and continuously transform ourselves. So it's not an easy industry to work in, but it is one of those few industries which have perennial demand and has multi-decadal visibility. And that is where our margin confidence comes from.
Thank you. That's all from my side.
Thank you. The next question is from the line of Ankur Rudra from CLSA. Please go ahead.
Thank you. And Ajoy, you will leave big shoes to fill. Best of luck. Maybe Rajesh, the first question. FY19 clearly was a phenomenal year on the growth front. You broad-based the growth as well. Do you think this creates tough comparables as we enter into FY20, or the strong deal wins, the TCVs you've had? We don't have comparable numbers for the previous year, and the momentum gives you confidence on maintaining growth leadership.
Ankur, we have runs on the board, and we have a great team. We intend to go out there and have fun and play.
Okay, so good to see the cheerfulness continues. Maybe then, Rajesh, you've been talking about the platform journey and the business 4.0 journey. How wide has your platform strategy been able to be successful beyond just insurance? And the business 4.0 as well, is that quite well spread across different industry verticals, or do you see more success in one of them?
Actually, great question, Ankur. See, platforms is a logical evolution of our products journey. So if you look at what we've done, we have been consistently focused on developing intellectual assets and systematically externalizing it as a framework, as accelerators, as products, point solutions, as product family, and finally as platforms. BFSI has been a great example. This is a net outcome of multiple decades of investment, and slowly we are seeing this in other industries. Retail is a great example where our domain capabilities are getting externalized more and more as products, and different product families are emerging. We also have examples of us starting off with a platform strategy like what we have done in ION in the assessment space, where we have really taken the scale that teachers operate at and are converting it into a platform which will change the talent landscape nationally. So we are putting our scale to the greater good of this overall industry and redefining how we go about looking at whether it is talent identification through assessment or training and the kind of reskilling that we see. And we're really putting scale to use and to the greater good of both the industry as well as for the company. So platforms has to be seen in that context. It is not a standalone element. It is not a bolted on strategy. It is a core strategy coming out of decades of investment. The business 4.0 question is actually an interesting one, and in fact the survey that we spoke about, which we have shared on our website, is a very interesting read because it shows how relevant across multiple industries. In fact, we were also quite surprised at the results that we saw while we were seeing anecdotal evidence of it in our pipeline as well as in the field engagement. To see across a wide array of 1,200 enterprises the kind of resonance that it is having, that quite frankly took us by surprise, and we are gearing ourselves up to make sure that we participate aggressively in the full extent of the opportunity in front.
And I have to ask a question of Ajay. Ajay, the data that we see from USCIS on approvals for most IT companies has fallen quite a bit, and so also for TCS. Is the supply situation, and the data we have is probably till December, is the supply situation stabilizing, especially given you've got a very strong order book to execute for next year? How are you thinking about that?
Yeah, of course. First of all, thanks for the well wishes that you mentioned at the beginning. Then from a visa perspective, I think yes, there have been certain challenges in terms of the rejection rates, etc., going up. And but at the same time, the situation is very similar to what it was last year as well. And it's a question of planning. It's a question of ensuring that you do your talent acquisition of different kinds in advance to meet that business requirements. So I think we'll continue to do that way. And from a overall point of view, I think we are in good position. So it should not be a major issue.
Thank you and best of luck.
Thank you. The next question is from the line of Divya Nagarajan from UBS. Please go ahead.
Thanks and congrats on the good execution in the quarter. Two questions from me. Rajesh, could you just run us through what led to this banking surprise that we've seen this quarter? I thought earlier we were quite confident of acceleration, but hesitant to call out a double-digit growth. What's really changed for you during the quarter to see this kind of, and what do you expect in terms of fiscal 20 outlook for the banking space in particular? Could you also then talk about retail for you? And you've seen some seasonality this quarter. Is that expected to wind off and reverse as the year progresses next year?
Divya, thanks. And banking, we have always been sharing the numbers, and this acceleration has been in the works for some time. It has been steadily improving. The numbers are now something that makes Kriti Vasan smile, and if I were to be able to deliver the entire thing for the full year, if I get 11.6 for the full year, I will also be very happy. But beyond that, I don't want to get ahead of ourselves and call any such turnaround or transformation. I think the teams are staying very, very focused. It's a very heterogeneous industry. It's a very wide spectrum, and multiple opportunities and multiple challenges across. Overall, Europe banking has been quite positive, whereas there are a couple of large banks where challenges continue, especially if you look at capital markets, which is the most volatile end of this industry. We are quite carefully looking at it as to how this whole scenario will play out. Insurance has seen much more broad-based demand and growth. So BFSI at 30% of our revenues is a fairly wide spectrum. But what's most important is that we have the team, and the team is well distributed and very focused. So we will participate in growth opportunities wherever they emerge.
And on the retail outlook?
Retail outlook also is difficult to comment. Let me tell you this, that from a medium-term perspective, we are very, very positive on retail because it is a fundamental part of the economy. And the kind of focus that we are seeing among the industry players to invest in technology and to take on the pure online players and the early successes that many of the large ones have had puts it up in a very strong position. But period-to-period volatility is very difficult to call. And if you were ready to ignore that and to take a medium-term view on it, we are very positive about retail.
Got that. And Ajay, wish you all the best for your future endeavors, and it's been great interacting with you. But before you leave, a question on the attrition number. Till recently, and even during this quarter, you've enjoyed one of the lowest attrition rates in the industry, if not the lowest. Do you see this under risk as the supply pressures in the industry continue? And what do you expect, the cost of retention for you is going to be in fiscal 20 and beyond?
Thanks, Divya. And so as far as the attrition is concerned, I think it should continue around the same level as where we are in the short term. But over a longer period of time, if the demand increases, overall the industry, the growth comes back, then of course it will have some pressure which we will have to handle. But at this stage, I do not see it posing a major challenge to us.
Thanks, and all the best for fiscal 20.
Thank you.
Thank you. The next question is from the line of Viju George from JP Morgan. Please go ahead.
Yeah, thank you. Congratulations on a very strong performance. Rajesh, I had two questions on digital. So when you look at digital growth, clearly what is quite marked for us is the increasing returns to scale, where digital is getting to be larger and larger as a percentage of revenues, and the growth rate is also increasing. On top of that, it's a $6 billion base. Do you think that this increasing returns to scale will continue for the foreseeable future, and or we should start to hit a lot of large numbers on growth on digital while remaining attractive, which will start to come down with base? That's one. Secondly, what's leading to this? Because it's quite interesting that on a $7 billion base, the growth rate continues to shoot upwards.
Yeah, I think it's answer to everything is interrelated. Digital, when we say digital is default, it is also becoming the default technology stack of many, many industries. So in fact, I am of the opinion that it is time to retire this term itself and just refer to technology as technology, because this is what the technology stack of the day is. So I think we need to stop thinking about it from that perspective. The other element is that we are again at the in the midst of a huge wave of innovation. This year itself, we have introduced almost 28 different service lines, and we are participating very aggressively across a whole plethora of new product companies. And it is similar to what happened in the e-business era in the early part of the last decade. So we are, it's very widespread, and that it is a large-scale architecture transformation that is ongoing in the technology field. And probably time for us to stop talking about digital and just talk about technology.
Sure. And, when you look back at the digital growth, there might be a little bit of the substitutive or the enhancement effect where certain existing technologies and platforms are made better, maybe because you're migrating towards the cloud or automating them with AI, etc. So, and then of course there's a lot of new stuff that's happening like IoT, blockchain, etc., but might not have existed 4 or 5 years back. is there any way to qualitatively say how much of a digital growth today is driven by new versus old, or new versus better old, if I can put it that way? And how do you change that, see that changing over the next maybe couple of years?
Sorry, Viju. Offhand, I can't think of
yeah, sure.
like that. But I would put the construct differently. I would say that if an enterprise spends $100 today, what is the percentage of technology in that spend? And if you think 5 years from now, in the $100 that they spend then, will technology constitute a larger or a smaller percentage of that $100? And the answer for every single industry is that technology will constitute a larger percentage. The reason being that there is no other line of spend which can actually claim to have a higher priority over technology. So this is the dynamic. Now, the specific area of technology that the money will get spent in will keep on changing. So our approach is that whatever is the technology that is in vogue and whatever is the one that is emerging, we need to invest and create talent for it, because it's a chicken and egg solution story. If we don't have the talent, enterprises cannot deploy it. So it gives us the time that is required to invest in this talent and to scale up and participate in it. And digital is just, that was a term that was used for this new technologies, but they are now the core technologies. Cloud, automation, mobile, social, these are all de facto. So as I said, time for us to stop thinking about it as an event and to think about it as the general fabric itself.
Sure. Thank you. And Ajay, I'd like to take a moment to thank you for the fantastic contribution to the services industry and to TCS. All the best going forward.
Thank you, Viju. Thanks.
Thank you. The next question is from the line of Parag Gupta from Morgan Stanley. Please go ahead.
Yeah, hi, good evening, everyone. So I had two questions, Rajesh, one for you and one for Ajoy. So Rajesh, just wanted to understand, you had a pretty smart deal signings in this quarter, despite whatever is being talked about on the macro front. So two related questions there. One is that could you give us some sense of what kind of trends are you seeing on the contracting sizes? Are you actually seeing deal sizes getting larger, or are you just seeing many deals of smaller sizes coming through? And the related question there is that while we haven't seen any large multi-billion-dollar deal announcement per se, I'm just trying to understand that is it that platform deals generally have longer sales cycles and hence may not come in with the same frequency as what would on the other hand?
On the first question, deal sizes, there is not much of a movement in any direction that is worth calling out. We do have an equal distribution of large and small deals from a regular perspective. So nothing material for us to comment about. On the platform deal, what you said is absolutely right. These are typically fairly long cycle deals and takes quite some time. So they're lumpy in nature. And so leaving that aside, in the regular set of deals, not much to talk about deal sizes. But we are also, this data that we are sharing with you, the level of focus and the level of granularity on this keeps on increasing. So with that caveat, as I said, we're sharing the data with you as is. In a few years' time, I'm sure we will have the same level of confidence and the granularity that we had in our cost and revenue numbers.
Great, thanks, Rajesh. And Ajoy, a question for you. Automation is something that I guess most vendors and service providers have been now embarking on for the last few years. When do you see automation actually starting to yield significant results in terms of metrics such as revenue per employee, better operating margins, etc.? Do you think we're now reaching a level where the scale is getting larger and you can actually see the results come through in a much more visible manner in the numbers going forward?
I think if you look at automation, as far as we are concerned, we have been talking about machine-first delivery model, and over a period of time, there's been a significant focus. And the kind of product that we have, which is Ignio, which is cognitive learning, and so this is already in play. So it's not that it is something that is going to hit us in future. It's a question of how well you are utilizing this and in what way it impacts your operational efficiency. And this is already playing out in our numbers. So it's definitely giving us operational efficiency.
Perfect. Thanks, Ajay. Thanks for all your help, and that's all for me.
Okay, thank you.
Thank you. The next question is from the line of Ravi Menon from Elara Securities. Please go ahead.
Hi, thank you for the opportunity. And Ajay, this one's for you. I think everyone's taking an opportunity to ask you one last question before you go. And
You don't have to ask.
yeah. So I think popular perception has been that there is a dearth of system architects in India, and particularly the IT services firms. And when Rajesh talked about the core transformation and spoke of how there is a lot of re-architecting, and the biggest barrier is usually the legacy stack and process tied to it. So is TCS different in that sense, or do you think that you've got a lot more system architects than others? If so, what's led to that? Is there something culturally within TCS that's helping you differentiate that?
I think the single factor that has helped us is our core belief in our own people, which is the kind of, for a good architect, what needs to be there is not only the technology knowledge, it is how it is applied and how the context of the place where it is being applied. So that is something that we have, and that's the core belief. And given that, we have focused a lot on building the competencies of our people, and that is what is helping us. So I think, in a nutshell, I would say that has been the core strength.
Thank you, and best of luck.
Thank you.
Thank you. The next question is from the line of Vibhor Singhal from Phillip Capital. Please go ahead. Vibhor Singhal from Phillip Capital, your line is in the talk mode. Please go ahead with your question. Due to no response, we'll move to the next question, which is from the line of Sandeep Shah from CGS CIMB. Please go ahead.
Yeah, thanks for the opportunity, and congrats on good execution. Rajesh, just want to understand about the 4 trends which you spoke about, more about the core transformation, because most of the others have been in the reality and talk for the last 3-4 years. But core transformation, just want to understand, where are we in terms of the journey, in terms of adoption by the clients? Are you believing is this in the early adoption stage where deal sizes which has started to move up may continue for next 3 to 5 years? Just wanted your color on this.
I think the push to quantify or push to qualify, we would say that probably it's in the early growth stage, and this is likely to continue for a period of time. As I said, we saw this in web technologies also, that towards the end of the last decade, large-scale architecture transformation programs were getting executed, and we are in that kind of a phase on digital technologies, where we're seeing large transformation programs being attempted and flagged off. The speed and intensity of it will, of course, depend on the capacity to fund it and the urgency to fund it, like in a situation like retail. But we are almost on an inevitable journey, and this will continue. It is only a duration. What is the time frame? That time will tell.
Okay. And is it more broad-based across industry, or it's more restricted right now to B2C and versus a B2B?
Again, it is industry by industry, depends. In industries like retail or earlier in media, it is extremely broad-based because it is transformative at the industry level, and it's practically minimum hygiene factor for survival, and therefore it is very, very broad-based. Other industries like banking and all, it is still selective, depends on the competitive position, depends on their aggressiveness, depends on product families, regions. So it's a mixed bag. But you can rest assured that in every industry, it is only a dialogue as to when to do it rather than if to do it.
Okay. And whether this dialogue is impacted by the macro volatility, what I meant to ask is actually the sensitivity to these kind of a core transformation deals with the macro volatility is reducing, or you believe no, this may continue to impact in terms of the decision making?
Again, as I said, it's industry specific, and industries in scenarios like retail, where it is a matter of survival, then the macro doesn't actually, if anything, it only accelerates the need to transform. In other places, it is dependent on the capacity to invest and the prioritization. We saw banking go through a phase where a lot of capital was being pumped into regulatory compliance, and as they have navigated away from that scenario, more and more money is now being moved to transformation engagements. So other industries, automotive you find is struggling to balance this need to transform as well as to fund their existing base. So there is no single answer, it is industry specific.
Okay. Okay. And just in terms of the order book, the momentum is really improving for the last 2 quarters. But if I look at the FY19 book to bill, it's 1.05x. And I do agree this is just a 4-quarter-old data. But whether that ratio when you enter FY20 versus when you entered into FY19, is it worrying you, or you believe no, there is more to it and time will tell? And as you said in the one of the reply to the earlier question, that the momentum which we saw in FY19 may continue in FY20.
Don't want to make a forward-looking statement, but when we started looking at this data, we had set ourselves a target of 1:1 for lack of any better benchmark on controlled data. As I said, our quality of this data and our granularity and then will improve over time. We understand revenue and cost a lot more granularly, and we understand the nuances of the data. We are early days yet on this data set that we're sharing with you. But we have been at 1 or greater than 1 in 3 out of the 4 quarters. 1 quarter we had 0.9. So overall we are not not too concerned. Trend lines will emerge over time. We'll talk about it as they come.
Okay. Okay. And just a couple of more if I can squeeze in. Just wanted within BFSI, some of your smaller peers are talking about client-specific issues, which because you are one of the largest vendor tends to be some of those accounts also material for you. So are you worried for a client-specific issue for BFSI demand entering into FY 2020?
We have client-specific issues on the negative side. We have client-specific issues on the positive side. Net where the balance comes, we'll have to wait and see.
Okay. Okay. And just last question on the supply side issues, do you believe could be a new margin headwind looking at the visa rejection rates entering FY20? And one of your peer today also mentioned that one of the reason for higher attrition for the industry is for some of the offshore employees are getting lower opportunity as besides the wage hikes, lower opportunity in terms of a transition from offshore to on-site location because of the preference given to the local employees. So that is also leading to some dismotivation to whether making a choice of IT industry versus other industry as a whole. So are we, your color on this, are we witnessing similar problems in the supply side issues?
I think, again, as I started this call, Ajay epitomizes TCS. TCS is about careers. TCS invests in people who have a focus on careers, and people who have a focus on careers see the value of TCS. I don't think people come to TCS for a visa or for a work location in one place or the other. And our strategy on that, our people strategy on that continues unchanged. And we don't believe that, and we have been articulating that just because the technology changes, this core value and core belief does not change. And we have stood by our people through this change. And we are very confident that our employees will stand by the company as the opportunity and the market improves.
Okay. 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 Thanks. This is helpful. Just last question. Sorry for this. Just on the electoral trust contribution, it looks like a non-recurring charge for this quarter. And what is the nature of this contribution as a whole? And one can presume that this would be a tailwind in the 1Q. Am I right in assuming this?
Definitely, the magnitude and everything can be considered as a one-off. You're right in your assumption.
Okay. Okay. Thanks.
Thank you. The next question is from the line of Sudhir Guntupalli from Ambit Capital. Please go ahead.
Yeah. Good evening, gentlemen. Thanks for taking this question and congrats on a good quarter. Just one question from my side. The strong growth acceleration in BFSI in this quarter, almost 300 bips compared to the previous quarter when you look at it on a YOY basis. Can you give some more color on what has driven this acceleration in terms of geographies and subsegments? Was this driven by European banks or US? And you have also spoken about challenges and volatility in few pockets. So any further color on that will be helpful.
Nothing incremental to add. I'll just repeat what I said. Europe overall as a geography continues to be ahead and growing faster than other places. But there are one or two large European banks which are going through their own periods of volatility and are challenged. But overall Europe geography in BFSI continues to do well. The insurance as a vertical or a subsegment under this is seeing good, strong, stable growth. And the capital markets as a vertical is one that is volatile and probably the fastest reaction to any macro impact, whether it be on the positive side or on the negative side. So beyond that, I don't have any further color to add.
Sure. Thanks.
Thank you. The next question is from the line of Dhanashree Jadhav from Anvil Share and Stock Broking. Please go ahead.
Good evening, everyone. Thanks for taking my question. My question relates to the Rajesh, you spoke about the legacy transformation deals that we are witnessing. So I just want to know where are we heading towards in terms of pricing? Are we doing something different compared to our peers or the overall industries that we are seeing this kind of execution? Thanks.
I think pricing and is becoming a fairly complex space because the deals as they become more core transformation led, customers are more and more valuing the capability that you bring to the table and the uniqueness of that capability and the solution set, and that is helping us both deliver a win-win solution which delivers greater value to us and greater value to our customers. So pricing is a net outcome of that, and I think it is a net positive for both parties.
But are we seeing stability pricing pressures that we have generally the commodity business is being witnessing?
It's an interesting thought to think about what are the characteristics.
Are we seeing some stability?
Yes.
Some color on that.
Yes. We are seeing quite a lot of stability in pricing.
Okay, thanks.
Thank you. The next question is from the line of Vibhor Singhal from Phillip Capital. Please go ahead.
Hi. Thanks for taking my question. Rajesh, I just had one question on the European geography. So I think we've had very strong performance in Europe this time around again, especially from UK. And I think time and again, year after year, we have seen a higher incremental revenue coming from the European geography for us than US, which has been the staple place for business for the entire industry and ourselves also, and it still is more than 50% of the revenues. So how do you see this European geography momentum continue? I mean, we know the large, a strong momentum in UK this time was probably driven by some of the large deals that we had won last year. But do you see us maybe hitting a plateau curve at some point of time in Europe? If not, then if I were to, let's say, ask you maybe a long-term vision in terms of, let's say, 7 or 8 years down the line, do you at some point of time foresee the European geography becoming bigger for us than the US market?
Your question is difficult to answer directly, but let me share this with you that because we started growing Europe later in our evolution cycle, our positioning in Europe is actually much stronger than our positioning in US. We are much more integrated in the growth and transformation agenda of our customers, and our engagement with our customers is much further up the executive chain compared to older customer sets that we have in our more traditional markets. So that positions us better, and it also makes us more entrenched in the scale. Having said that, the sheer size of the market in US and our continued focus on repositioning ourselves in that market should also come back and deliver results for us. but that is our long-term focus.
So US will probably still remain a primary market despite the fact that Europe continues to grow at a much stronger pace.
Absolutely.
Sure, that's helpful. And the margin profiles also, if I could just squeeze in the contracts or in most of the engagements that we have across the countries, would probably be similar as well.
Pricing is of course geography dependent, and margins are more complex than that. Margins depend on the country, delivery model, the nature of the engagement, scale of that relationship, etc. But
right.
Pricing is typically, given the fragmented nature of the European market, pricing is typically higher compared to a large-scale market like US, where the economies of scale have resulted in lower prices.
So if I were to reduce on a like-for-like basis, probably the pricing would be probably a little bit better in European fragmented markets than the US market.
Absolutely. And it's probably true for not just for services, for every product or anything that you consider. US is probably the lowest priced location among developed markets. The comes from the size of the market.
Sure. That's really helpful. Thanks a lot for taking my questions, and wish you guys all the best.
Thank you.
Thank you. The next question is from the line of Viju George from JP Morgan. Please go ahead.
Yeah, thank you for giving me an opportunity again. Rajesh, I just had want to get a sense of how your org structure and design is keeping up with the base. I think towards about 10 years back, just over a decade back, you did segment yourself to 30 or 35 decentralized units. How has that evolution further come along as you increasingly see multiple service lines and you also deal with base? How are you positioning on that axis?
So the basic organization structure, especially on the P&L line, continues to be exactly the same as what we had earlier. But that organization structure, like we had said at that time, is massively scalable both vertically and horizontally. And today at the granular node level, we run almost 150 P&L units from industry ISU perspective. And we see this structure as fairly, it is like a technology architecture. It's a modular structure, self-sufficient in itself, and therefore massively scalable.
Got it. So, okay, so each of them is kind of run like a single company where these synergies are derived from each other and from the parent. Is that the way to think about it?
Absolutely. They are independent, autonomous, self-organizing.
Got it. And one last question here on pricing. I mean, obviously the cost of operations is rising quite a bit in the US. Do you think that the industry and TCS will have success in passing some of that to clients? Over time?
I think so. In fact, while there was comments earlier also, if you look at price resilience and compare it to any industry on a like-to-like basis, the technology services industry has the highest price resilience among anything. My favorite example is we think about a premium phone. The like-to-like price of that model 3 years later or 4 years later, the price collapses by 50-60%, if not more, even for the most premium of that product line. Whereas in our industry, price resilience is phenomenal. 4 years later, price collapses will not be more than 5% or 10% at max. So this is a beautiful industry from a price resilience perspective. I think it is misunderstood as a commodity. It does not have any characteristics of a commodity. Huge price resilience, very large switching cost, phenomenally differentiated purchasing, and incremental purchases are not possible. The purchase decisions are fairly large and long-winded. So I think the understanding of this industry by many commentators is fundamentally flawed. It is not a commodity, which is why our margins are as resilient as you see.
Sure. Thank you, Rajesh.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you. So to sum up, we had a strong Q4 with broad-based demand across industry verticals and geographies, resulting in a revenue growth of 12.7%, the highest in 15 quarters. For the full year, our revenue growth was 11.4%, the highest in the last 3 years, and our operating margin expanded year on year to 25.6%, showing good resilience. Over the last 12 months, we have seen our Business 4.0 framework resonate very well with our customers and drive greater demand for our digital transformation services. The other 3 key drivers for growth were our customers' innovation spending, agile and machine-first delivery model, and the core transformation initiatives that we spoke about extensively during this call. Lastly, our order book in Q4 was the strongest in the last 4 quarters. The deal pipeline is also very good. That and our strong exit from FY19 gives us comfort on our FY20 outlook at a time of macro uncertainties. Thank you all for joining us for this call today and have a great evening ahead. Thank you and goodbye.
Thank you, members of the management. On behalf of TCS, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.